An increased interest in mindfulness, meaning you're living very much in the present by being highly conscious of your thoughts and feelings. However, being mindful doesn't mean acting on those thoughts and feelings all the time. Joining us now, Stephen Jurison from Edward Jones to explain that. But before we get to that, we absolutely have to talk about today's latest market plunge. I mean, we're talking about close to 1,200 points here, more than 3,000 in the last several days. I mean, that's more than 10%. What's up?
So, just by and large, anytime that there's uncertainty that hits the market, you're going to see this volatility. I think that moving forward, once we start to understand what's going on and what's either going to treat or cure this disease, is going to see better volatility or less volatility moving forward, should I say.
So you see more good news about the coronavirus if we can get a handle on this thing,
Exactly.
or when we get a handle on it.
Exactly.
All right. Let's talk about mindfulness. And, how can mindfulness, the phrase we're using, be a valuable asset when making investment decisions?
Well, with mindfulness, your decision making is based on cognitive skills tied with a rational perspective rather than emotion. So with that in mind, the two most common tendencies associated with investing are fear and greed. So starting with fear, one of investors' biggest fears, of course, is going to be losing money. So how did many of them respond during the steep market decline from late 2007 through early 2009? Well, they began selling off their stocks and stock-based mutual funds and fled for safer investments such as treasury bills and CDs. But mindful investors witnessed the same situation and saw something else, a great buying opportunity. Now, by looking past the fear of losing money, they recognized the chance to buy quality investments at a bargain price. And they were rewarded for their patience, long-term perspective, and refusal to let fear govern their decisions, because 10 years after the market bottomed out, it had risen about 300%.
Yeah, some big numbers there. Let's talk about greed. It's always playing a role in this. What can investors be mindful of when it comes to greed?
Well, we only have to go back a few years before the 2007-2009 bear market to see a classic example of greed in this investment world. From 95 to early 2000, investors chased after almost any company that had .com in the name, even if companies had no business plan, no assets, and in some cases no products. Yet the rising stock prices of these companies led more and more investors to buy shares in them, causing a greed-driven vicious circle. Now, more demand led to higher prices, which led to more demand. But the bubble burst in March of 2000, and by October of 2002, the technology-dominated NASDAQ index had fallen more than 75%. And since some of these companies not only lost value, but went out of business, many investors never recouped their investments.
Yeah, some household names simply disappearing, and we would barely remember them now.
That's right.
How can investors avoid the dangers of both fear and greed?
Well, make sure that you have an understanding of what you're investing in. So, for example, knowing the quality of the products and services or the state of the industry. Tailor your investments to your risk tolerance and be sure to rebalance when you're out of alignment. And keep investing. Investing over time can reduce the effects of the volatility in your portfolio.
All right, Stephen Jurison with Edward Jones. Thanks for coming in, kind of sorting it out for us tonight. We appreciate it.
Thanks for having me.